All opinions expressed by the Kendall Report participants are solely their opinions and do not reflect the opinions of VPM Partners, and may have been previously disseminated by them on television, radio, internet, or another medium. You should not treat any opinion expressed on this broadcast as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of an opinion. Such opinions are based upon information that the Kendall Report participants and Robert Kendall consider reliable, but VPM Partners does not warrant its competence or its accuracy, or should it be relied upon such. The Kendall Report participants, VPM Partners officers, directors, employees, contractors, guests, are not under any obligation to update or correct any information on this broadcast. The Kendall Report participants are professional traders or investment advisor representatives who may be actively involved in securities herein on behalf of themselves, their companies, and their clients. Also, the opinions expressed by the Kendall Report participants may be short-term in nature and subject to change without notice. No part of the Kendall Report participants' compensation from VPM Partners is related to a specific opinion they express. Past performance is not indicative of future results. Kendall Report participants and VPM Partners do not guarantee any specific outcome or profit. You should be aware of the real risk of loss and following any strategy or investment discussed on this broadcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned in this broadcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this broadcast. Before acting on the information on this website, you should consider whether it is suitable for your particular circumstances and strongly consider seeking personalized advice. Nothing contained in the Kendall Report broadcast or VPM Partners on its website or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by any particular security, other investment product, transaction, or investment. Copyright 2017 VPM Partners and the Kendall Report, all rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic media in whole or in part is prohibited under penalty of law.
Welcome everyone to the Kendall Report for Monday, March 25th. It's hard to believe the first quarter is almost behind us. I guess we're having way too much fun. Last week certainly had lots of twists. We saw a new high, and then the realities is that markets have become highly emotional. They can move really fast now. The digital world is much different than the old days when I started in 1979, when 40 million shares was a big day. That was the first nanosecond. It has been turned in, and the AG has made some comments about it. I'm sure we'll see a lot more of the report. But, you know, that's more or less behind us. There's some out there that don't want to let it go. Now there's another conspiracy over the conspiracy or something. You know, let's go forward as a country and make this place really roll again. And right now is this recessionary scenario. Just because the yield curve inverted for a couple of days, not everybody, but it's become a big story because the storytellers and the mainstream financial media have to have something to talk about to the interest rate section of the show today. But the bottom line is that, you know, there is no recession. There's not even any signs of one. And on the yield curve inversion, I had, let me just see if I can get over there and Terry last night. Let me just bring that up real quick here. Yeah, so let me go full screen, see this a little better. So this graphic here is showing the inversions. You can see the inversion down here. We went through, well, it was anywhere from a year and a half to, in some cases, 2 years before we actually saw a recessionary come in. And there were still expansions going on during those times after the inversion occurred. So maybe it will mean something, maybe it won't, but the bottom line is that the whole pattern that's that people are talking about, this thing is way down the road yet. This is not something that you need to be worrying about today. And the market participants came in, and we saw some hit the Fed last week. You know, all the dovish stance. You know, and I've been arguing for a while, is a dovish Fed actually a good thing? And the interest rate scene, the quantitative tightening is on markets. There are some movements. Not every sector is hitting, on full. I talked about in commentary that the manufacturing and GDP this week, and that's the case. So by the way, if you do hear any funny noises, they are doing major road construction in front of the office today. That was an interesting thing to come to. So at the markets, the fundamentals and the backdrop of this market, it's still overall pretty strong, and we're not even close to entering any type of recession. But market participants, the whole sequence here. So let's take a look at the schedule real quick for this week, and you can see here it's pretty light. You've got Dallas manufacturing Fed that came out. Let's take a look and just see how that came out. By the way, these people at Econo Day do a great job, so I'm going to give them credit. I really like their site. They've got some good stuff going here. Manufacturing actual was 11.5, prior was 10, so that's an uptick. So we're probably seeing some of these numbers that those are anything real big, but here we are again. Richmond Fed Manufacturing Index will be released tomorrow, and then on Wednesday we're looking at, which is expected to show a 2.2% increase, and then jobless claims, typical pending home sales, and that'll be at Friday. There's just virtually there's new home sales and consumer sentiment, but nothing real big there as far as that. Always a fun time of the year for allergies. So in Arizona, things happen earlier than other places on the planet. So anyway, let's talk a little bit more about the Fed and what they were really saying last see yet, but the overall dovishness that they have may be really premature. Everybody, this recession risk is, I think, premature. I don't think that anything's there. Several months to even have this indicator be a valid indicator. And everybody's talking about the 10-year. I don't say it. We'll go through it in the interest rate segment. So let's go ahead and dig into the S&P here, and I've got a short-term graph here. Let me just switch this over. We'll do our typical daily bottom-up view. So we're looking here. We came almost down to the 40-period moving average, which right now is at 2765. In commentary, I talked substantially about this 2761 level. That is the absolute floor of this market. We get down to 2785 today. I suspect we can rally back up to maybe by Wednesday or Thursday, and then that should be the bottom, and then we'll see the market start to move back up and challenge that 2860 high that we made last week. See a couple things that are going on here with we'll look at the Fibonacci projections that are on the screen. 2857 was a men. We hit that with a high last week of 28, actually on Friday. 31 was the high of this pattern, which satisfied this 2857 minimum target. The upward targets now are 2908 and 2940, which is a retest of the all-time highs. And I suspect that this is still in the cards. I don't see this thing failing. This is a little minor that we've seen in the first segment of this wave 3, or the wave 1 of 3. We're looking at about 100, call it 280, without doing all the calculations live on screen. I'll cover this in commentary over the next couple of days once we get a confirmation that we got a bottom of a wave 2, so I can measure where this thing is likely to go to. But you can see here charts. So we got ppm1 at 0.07, 0.02 on ppm2, and 0.12, and that is the overall the pattern that's unfolding here appears to me to be a very natural kind of pattern from the standpoint the symmetrics of all of the patterns that are fitting together here. So let's take a look at the weekly graph. And just for a second here, I'm going to take off the price ratios here. So when rocketed all the way up, this thing got to 1.47. It was huge, this big spike. Now we're seeing this thing come in and actually set up right along this moving average here. It's interesting, the things that are going on here. I talked about the average actually 6.5. 27 is the 10-week moving average, which is support. If we go back one level just quickly, you'll see that the 40-period moving average is very similar. It's 27.6. You can see exactly what's going on. But the weekly graph here is pretty powerful. You got plus 0.47, plus 0.14, and 0.04. So all these averages are turning up underneath here, which tells us there's a likelihood of a move to the upside. It would take a penetration of 20 or another barrier, and that should continue to act as support at this time. So the pattern overall is pretty bullish. Let me just pull this around. Let's draw a couple lines here. Yeah, so what's likely to happen, and I suspect that we're going to get a pattern like this, and then we'll start to realize some of these objectives. I took down the Fibonacci, but they're expecting to be in the 3,000 to 3,300 range. And we continue to see these markets just set up these patterns, and they did the same thing over here. This is the same pattern. Those of you who watch the show for long, and this is a very similar pattern that keeps unfolding. So we saw the same thing in 15 and 16. This is a little broader pattern, and out of that, of course, came this big rally here all the way up into 2018. And as I've talked about, let's talk a little bit of Elliott Wave for a minute. What I'm looking at here, originally I had believed that this upward sequence to the new high last year at the 2940, it just failed at the wrong time. We should have went to about 3,000 and change initially, and then that big decline we saw in the fourth quarter. So this becomes, where I'm drawing this up arrow, an A, B, and then this is a C wave, and now we're into 1, 2, and this is 3, and then there'll be another 4, and then another 5. And I'll talk about those calculations down the road. They're pretty much unimportant to come up with some long-term projection at the moment until we see more of this pattern unfolds. But everything seems, from us looking at Fibonacci symmetrics, everything is about as perfect setup as you can. The PPMs are also confirming that. When you're getting confirmations across the board on the indicators from the standpoint of momentum confirming these patterns, and then we're seeing the moving averages set up. So this wave 2 could go a little deeper than from here, but it looks to me that it should be fairly shallow, and we should start to move back up again this morning. Resistance 1 was 2810.15. So we basically traded up to that level. That's a pivot point in the intraday for today. The other one was 2791. We penetrated through that and went down to 2785. So we pretty much satisfied the range for the day. We've hit almost S2 and R1. There should be a slight bias to the downside after Friday's action. There's a 70% probability now that we have a low for the day. And so there's not, probably come back down, see how we close today. We should see maybe a 2-day decline, and that'll complete this wave 2, and then we'll be set to move higher again. Let's take a look at the monthly graph. And this is just kind of an expanded version of this. Let me pull this around so we can see this just a little bit better. And what we're looking at here is, this is just a confirmation of pattern, but let me show you something here. This is, I think, interesting. So I was talking, and right here is that pattern right here where we actually had where the markets went down and made a slightly new low, and that was the reversal. What we saw here is a low off of this pattern here. So this will be the most likely pattern. I want to show you something else here. This is a pattern a lot of people have been talking about, this bugle pattern, and I think it was, people were just, everybody's talking about this bugle pattern. Well, the bugle pattern ends up to be a bullish pattern. I probably have said this before, but it maybe not. But I think probably Edwards and McGee is potentially the worst market book I ever read. And I read that back in 1979, 80. It's just terrible. It just appeared that every formation that they're teaching, what I call book-taught technicians, that just about everything got it wrong. And there are scenarios that, you work in this range like this, and it just usually doesn't work that way at all. This happened in 92, right before we came into a 96, 97 high. And then, of course, 98 through 2000, early 2000 was the dot-com boom. So it was a precursor to that pattern. There's even an argument, I'm going to just stay on this thought for a minute. You can see there's even an argument here if you wanted to draw this like this. Here's your bugle. Which way did the market go? And here, like I said, here's the other one. It's a little broader in formation. And this is same pattern. We're recreating this scenario. And just about all of these patterns that was McGee, snafu again, just about everything I saw when I was researching and learning back in the day how to be a technician. I thought, here's a book on how to do it. It's the wrong book. I think it's CMT is a cookie cutter technical analyst. There's a few guys that have done pretty good, but for the most part, they've got everybody thinking the same way, that's how it works, only to find out later that pretty much knocks and taking risk in the markets. So the patterns that we're seeing, just to summarize a bit here, and then we'll go into the database here, they didn't change from a one-day sell-off. The markets are going. There's not the question right now is not where should telling you everything you need to know. These trends are all sloped up, 4 or 5, almost 500 shows. You can see that the PPM over and over and over again, as this continues to be 200-week moving average, but you're seeing that all of these patterns, the slope is turned back up again, and it's going to be critical. I would like to see a close above 28.15 this week. It showed you just a few minutes ago at that, up toward the ATH all-time high at 29.40. So let's go back over to what we're seeing here from the database. There was almost the exact same amount. There was 65 sell orders and 118 buy orders. So nothing really happened. So if you expected that we were going to see a lot of selling because of Friday's collapse in prices, the answer is no. And this range that I was talking about in the S&P, this 28 or 2785-ish, as far in the extreme down to 2761, but up to 2850, that's going to be your trading range. That's where we're going to consolidate here, which will ultimately represent a wave 3. Sorry, a wave 2 of 3, which will be the corrective phase before we enter the next sharp move up. You see the database continues. It's around 50. It's 51 and change. This thing rounds off here. But if you look at, there was some rotation going on in some of the sectors, but when you break it down to the industry groups, you can see there's not a lot. There was some selling off of home furnishings, but none of the major sectors. In fact, insurance, some of the financial sectors sectors are still very positive and growing. Others are seeing a slight rotation. Like here's a good one with food processing example. There was 2.11% was buying and 2.11% was selling. So there's just a rotation going on in some of these sectors, and that's the type of things you're going to see in this pattern. So let's go over and take a look at VPM 2.0, and let's dig into the database a little bit. Sorry, I thought I was already logged in. So when we look at the database here and we look at research here, we're now at 51.41%, and there's still only 2 sectors long. So we haven't been able to get on a weekly intermediate basis any more sectors from the VPM viewpoint to rotate in. We continue to have services long. They've been long now for 24 days, and utilities have been long for 104 days. We're up about 3%, but there was some really good opportunities in utilities, which is an interest rate sensitive area. But the rest of these sectors are remaining in a flat percent. We got up to 84% long. We backed off, and we're seeing some rotation. You can see the VPM universe chart here on a daily basis, setting up almost this perfect ABC, and this will probably be, this is telling us exactly the pattern I was talking about on the S&P. This is very, and if we go just real quick and we click on the VPM universe in 2.0, you can see here, if I go back over to the weekly, you'll see this thing is set. It's got a little different pattern, and I talked about this a number of weeks ago, is that the VPM universe chart did not make an all-time new high. But we're looking at the momentum is very similar looking to what it is in the S&P. You look at the PPMs here, they're very similar. Let's go back over and let's take a look at, this is important to keep a handle on as we go from week to week, and that this positions overview, if we look at the optimal weekly, the optimized weekly, it is 210 days average holding, and right now the average profit is 31%. Duration fulfilled right now is actually about 11%, 0.114. The average current duration is 24, and so we've got like 180 days. We had a good solid six to 8 months of this cycle to complete itself from the standpoint of all the trades we got long. And we got a reasonable number of stocks long, symbols long at 89.61. So there's a lot, pretty good traction there. If we get above 0.58 bullish, maybe 0.62, then that will set the tone for a pretty strong rotation and will confirm the next level trend up. Research going on, that is, we're researching and doing some data. 54 to 56 is the next trigger point. It'll take us up to 62, 68, and then the participation rate of the cycle. So most of the stuff, as you can see here, when you're looking at this stuff, about 210 days, which is the better part, to be a lot of dynamics. It's going to take a lot to knock down 9,000. Let's head over and let's go back now. And I continue to and as we look at this would be a base around the 255, 252 level. Well, we've obviously went through that. And I think all of this stuff is getting way overdone. But now all you can expect is definitely some huge downward pressure. We're looking at ppm1 at 0.06 minus 0.0. These indicators are telling us there's a short-term and very robust downtrend. Back up into this range, like I said, 256, 260 will be said. The big numbers everybody's going to look at are going to be manufacturing. Take a look at the intermediate. And the intermediate is telling us exactly what downtrend is real. And, I think, and we'll see it here in just a minute, be the bottom of this pattern. So, but there's substantial amount of downward pressure, which suggests everybody was geared up for, once again, has failed, which was higher rates. I was talking about some kind of update. 40-month moving average, that's at 236. We're pretty close to it. We do also have 283 level. I do expect to see probably the bottom of this 42.36 to so let's take a look. Let's go ahead and go from the interest rates. Now let's do one more thing. Let's see here. A couple things I want to do here real quick. This has SHY, and the put in the 13-week. Important one to watch here. But first, I'm going to put in the 10-year. And I did them inverse, so as this thing goes up, we're at a minus. So this looks like a steepener, but it's actually, I put the symbols in backwards. So what we'll look at here is this. You'll see it better up on this chart here, which is 0.41, and the 13-week T-bill is at 2.39. So we're very close to inverting. But as you can see, this pattern came down. We got a little bounce. We had a steepener. I talked about that a fair amount over the past several weeks, and now we're seeing. So I don't expect that this is going to be a major factor as we go forward. But the whole scenario that's happened in these rates have been substantial. You can see that the 30-year way up here in the blue line has really maintained its lows. Everything else, the year, but also in the 10. You're looking at, quite a bit of move from 250 all the way down to 242 here on the 10. So this is really an interesting pattern that has set up here, to say the least. But we are on major support, which tells us that we should set up some kind of trading range, and then we'll still start to see some things move higher down the road. So let's switch over to the Dower, which was also talked about quite a bit. You can see we've seen this decline on the Dower here. And let me go full screen here. You see the Dower here has fallen back, but it's really still within that same range that it's been in for a while. It's been locked into this sideways trading range, and this is, pretty much as expected. We spiked underneath the 40-day moving average and then rallied back above it. We look at the intermediate. We're looking at quite a bit of support here. Notice that for the most part, the 21, which is the cyan line, and the green line, the 40, are sloping up. You look at PPMs, they're positive, not by a lot, but there is support being generated by this pattern. So it would take a number of, probably another 3 to 6 weeks before we would see any type of pattern going on there. Let's go into the monthly graph, and you see here, this has got a huge uptrend, 0.41, and this is the pattern we could fall back into here, which would represent a move back toward right here, around 92 to 93. I really don't see that happening. If it does, then this will set up a pattern which will ultimately catapult us up over the 17 highs and go to much higher prices. I'm going to bring up something here that I didn't have on the other charts. Let's take a look at the studies. Let's look at the price ratio. This has kind of got a little fat lines, but let me just bring up these numbers so you can see them. But the high target's 101, middle target 105.49, and then 107.7. So this is a pretty substantial. Let me change this over so this will be a little more visible real quick. This is a little better. So you can see these three upward objectives here. If I go back to the weekly, I just want to show you there's numbers there as well. There's a short-term number which is suggesting 98 to 101, and then this calculation here, while stop calculating is still valid, it is projecting 101 to 106. So let's go over to and take a look at gold. And I've been talking about gold a lot. In that last decline, I suggested that we're going to see this thing move back towards that 1340 level. We've done pretty well. We printed a low over here at 1287, and we've been moving steadily up here. This is the weekly graph. Let me go to daily just real quick here. So you can see here that we're breaking through these highs. There are Fibonacci projections for a move to 1332 to 1360. I've talked quite a bit on the longer term graphs is that the key numbers 1370 and then 1400 is the big pivots above the markets. Now it's interesting is the markets have, market participants have actually been talking about, with the Fed having their foot off the table, that maybe the Dow will decline and we'll see some pretty substantial moves from this down, pushing up into some of these levels I've been talking about on gold. I still think gold is going to continue to be a hedge that's being put on as people get nervous. Even if the market starts to go back up, you're still going to see the gold and the stock market go up. Interest rates, I think, just based on what we just looked at across the board, are actually locked into a range. We're going to call it 236, 265, 270. So we're going to work that range. We're not going to get above that for a while. And so that's going to be just stable. That's going to give the gold folks an opportunity for them to not be concerned about higher rates or the Fed and all that. So this market's going to start to trend, and you'll see a lot of cash flow, I think, into this in the weeks to come. So we'll finish on this next market here. Let's take a look at crude oil. I've spent a fair amount of time talking about crude, and I think the setup here, let me get over to a shorter time frame. Let's start off with the daily. And what you see, excuse me, what you're going to see here is this pattern that's unfolding. I just want to take this off. Just to get a better view of this. But you can see here is that crude has been moving up, even though it backed off the last 3 days. You're really looking at, a pattern that is overall still bullish or still an uptrend going on. This is the short-term look of this thing. See, we came down to the 21-day moving average pretty much at the 57.81. The low was 57.17, so we spiked just a bit under it. Now we're heading back above 10-period moving average. And as we go and take a look quickly at the weekly, you'll see this pattern. This is setting up the final bottoming pattern. Now, it's interesting to think about this. And, one of the things that continues to go on that maybe it's not talked a lot about, but it's really what's going on in Venezuela. And I don't know if I haven't seen any confirmation, but I heard that Russian planes landed with Russian troops on the ground, which is kind of scary if you think about it. It's these small scrimmages that get played about, especially with the Soviets and, of course, in the Germans in the past, that set up these big potential conflicts on the planet. Now, if there was a disruption, complete disruption in Venezuela, oil, things of that sort, this could set the tone for a big move up. And I'm having a bit of a flashback to 1990, and I was a head financial analyst for a company called Stotler & Company, and I had the entire firm up to here long crude oil at around $18, and somebody asked me, I had projected we would go to somewhere between $28 to $32 on crude. And someone asked me why. I said, I don't know, maybe there's a war or something. Of course, there was. Actually, on my birthday was the invasion in Kuwait, which popped the market to around $32. We all made a bunch of money. It was a fun trade. But, I'm having the same kind of thing here. When I look at this pattern, this is a really bullish pattern that's set up here. It appears to me that we'll easily get above the $70 range, and we might even see something much bigger. Let's go over to the monthly, and you'll see here this pattern is set up is pretty interesting, because on a monthly graph here, you're going to see that this pattern is a little deep, but my expectation is that we're going to get up to around the $80 level. Let's put some Fibonacci objectives on here, see if anything is out there. So there is something interesting. This right here, 64.76, is a major pivot number. So just about $8 above $7 where we are right now. This is a major pivot. We close above that number. That's going to be 70.68 is that number. 70.68, I had the wrong number earlier. But yeah, so 70.68 is the key pivot. A move above that is going to set this thing on fire, and you're going to see us move probably up to, I would suspect 95 to 105 level. Maybe that sounds a little crazy, but it won't take much to disrupt the oil market to cause this thing to go back up. That's for sure. And ultimately, what we're likely to do is this right here, is that we're going to wipe out the decline that we saw back in 2015 you remember. It's somewhat interesting, right? The disaster scenario was that crude oil was going to go down, below 30, and it's going to stay there. And if you look at it, from a big scheme of things, we've been locked in a range. We're trading in that same range. We've been locked in at, we'll call it 45 to 65. And this next move up is likely to be pretty substantial. So what we're looking at here is a move like this that would put us, and ultimately my bet is that we head back to the lower end of that range, and we could even end up falling right back into that range. Let me draw this a little better. And this the numbers on this chart are skewed because this is a nearest futures graph, so it has premiums in there. But this is based on the premiums, everything. This is potentially seeing a double in crude oil, and that would be, by the way, probably a 2-year plus trend that we're talking about, looking at very long-term trends here. And there would be a lot of work just going back into this thing that will potentially be done in this range here. Let me just pull this back a touch here. And what you're likely to see here is just this. So you get to this range here, and then you're going to just move back and forth. And this could be a consolidation range. It doesn't have to just go straight up from here. We could consolidate here, but certainly some of these events and things that are going on in Venezuela right now could be a trigger. They're a big player in oil. You disrupt that, we get some other things going on. Who knows, some naval blockades, all the stuff that's going on down there, humanitarian issues and things of that sort. So we'll see how this all plays out. So let's go back in a final review of the show here and take a look at what's going on here. Everything's backed up again. The composite's down 20, S&P down 541, and so we're also looking at the patterns that are unfolding here as far as the the trends go. We're still looking at this pattern that I talked about earlier. So it's not really that good as far as the things go from from blasting out of here right away or collapsing. So I expect to see a consolidation this week and set up a trading range 28. I talked about this earlier, 28.20 down to the as low as 27.61, but most likely this 28.80, 28.70 level is going to be the bottom end of the range. So thanks for watching as always, and I will talk to you next week at the same time.